Okay, everybody, we're going to take a close look at silver and what exactly is happening with the white metal. We're going to do what I call, or what we call, a forest to tree approach. What that really means is looking at the big picture first for the background in what is happening for silver generally. And then we're looking at so that's the forest, if you like. And then we're going to zoom in and look at the trees, which basically means looking at the detail of what is happening on a much sort of smaller scale, much smaller time scales. So the big picture for silver really is dominated by the same thing as gold, and that is whether or not we're in a precious metals bull era. Now we know we're in a gold and silver bull market because the charts have broken out above key points and they're above rising trend lines, rising moving averages and all that sort of thing. So we know that they're in a defined bull market, but are they in a bull era? And this chart here, the gold to SPX ratio, tells you whether or not we're in a precious metals bull era. You can go back to the 1930s here. Gold was actually pegged. The US dollar value of gold was pegged. And we broke out on this gold to SPX ratio, and it kind of broke the peg actually, and gold had to be revalued, so that the peg was adjusted. So that was the 1930s. It's a little bit harder back then to see clearly what's going on because gold wasn't exposed to free market forces. But it certainly was in the 1970s, and we had the same pattern again. The gold to SPX ratio broke out. It was less of a V-shape breakout and more of a gentle arc-based breakout, a little bit like the one that we're seeing at the moment. But there's a breakout there, and the 0.5 level started to identify itself as a key sort of resistance level at that point, and it did so again back in the early 2000s. I mean, what happens when this chart rises is that gold is outperforming the S&P. So that's a precious metals bull era, because the S&P under normal circumstances would massively outperform gold. So you can see here from 1980 to the year 2000, for 20 years, the S&P massively outperformed gold. The chart was dropping, so the S&P was outperforming gold. Now, if we, and I'm just going to put on the 28 period moving average there so that you can see it as well, because the label is there. If we look at what's happening today, we see this 0.5 level again is a support and resistance level. It proved pretty important back there in the previous bull breakout in 2008. It got above that 0.5 level. Now we've not fallen much below it. We haven't come all the way back down to previous lows on this ratio, and we're already forming a basing pattern to break out from. This kind of lines up with a number of other charts that suggest that in many ways the period from sort of 2011, 2012 through to about 2015, 16 was just a sort of a pause in the ongoing precious metals bull market, and we've been gradually building a breakout since then. Certainly, as far as this ratio is concerned, we've been going sideways for at least half a dozen years, which means gold has been keeping up with the S&P. The S&P hasn't been able to outperform gold. So this is the first prerequisite of a precious metals bull era, but we haven't got the final piece of evidence yet. We haven't broken out above 0.5. We haven't got above that clear support and resistance level. So it's a bit difficult to say we're in a precious metals bull era based on this chart. And in fact, it's probably the last chart to confirm that we are in a bull era, because there are many other ratio charts like gold versus money supply, gold versus DXY, gold versus sort of CPI, PPI, inflation. All of those sorts of charts are showing that gold is breaking out into a new bull era. So this is versus the S&P. So it's interesting, isn't it? A lot of people have said that if you strip out the top few names in the S&P, then gold would be breaking out versus the SPX. One way of visualizing that actually is there's a chart that we can get on TradingView, and it's the equal weighted S&P. So it kind of weights all the stocks in the S&P equally. It doesn't, for example, Nvidia, which has a very disproportionate place in the S&P 500, it doesn't give that the large weighting that it actually has. So the fact that it's over 3 trillion market cap is kind of balanced out because it's given an equal weighting to the smaller companies. So we can sort of level the playing field by using that chart. And if we do that ratio versus gold, so this is the SPX equal weighted, SPXEW versus gold, what we can see is a more clear sort of rotation taking place. So when this chart's rising, the S&P equal weighted is outperforming gold, and when it's dropping, the S&P equal weighted is underperforming gold. In other words, gold is in a bull market. So for a precious metals bull era, we need this chart to be rotating and moving downwards. The upwards trajectory, the upwards momentum needs to decline, and we need to start to roll over. Well, we've been doing that, and a number of support lines have actually been broken already, rising trend lines. And another one that we're resting on right at the moment is probably the last rising trend line just about that you can draw in this chart. I suppose you could start drawing ones like that, but we're already broken below that actually. If you start using this point here or that point there as a starting point, then these trend lines have already been broken. So it's probably just about the last rising trend line that you could reasonably put on that chart. There's a horizontal support and resistance zone just below where we are at the moment. But regardless, this chart does appear to be rotating in favor of gold, and we've already moved from a low in 2018. I think it was $1,200, was it? Was it that low? Perhaps it was. Let me just put the gold chart on top. Bear with me a moment. Let me add the gold chart, and we'll see where the gold price was at that point. So here and here. So yes, it was $1,200 gold. Of course, we had the low back here, which was 1,050. But when we hit the top of the inverted arc or dome there, it was 1,200. So that's correct. That's good. I just wanted to double check that was not misleading. So we've moved from $1,200 gold in 2018 to $2,500 gold now. So gold has doubled as this rotation is taking place. So that's your forest to tree. Well, that's your part of your forest to tree approach. We've looked at the forest. We've looked at the evidence that we are gradually entering a precious metals bull era. Oh, and by the way, should we get down to the bottom of this dome, then my target at the moment, as it stands anyway, is anywhere from about 8,000 to 12,000 gold. I think that's a reasonable sort of expectation. Gold tends to double, then double again, then double again, and then sort of rise a little bit more. So you can see at least two or three doublings of the price of gold. Okay, so that's as I say, the big picture. Now zooming in a little bit, or a little bit more detail here, the gold to silver ratio. In a healthy bull market move, you often see silver outperforming gold. It's not always the case. So this is just one piece of evidence that you'll be able to point to cases where in a precious metals bull era, gold is outperforming silver. So that certainly does happen. But as a trend overall, or at least at this stage in the process, you would want to see silver outperforming gold, because silver, of course, is lagging a long way behind gold. So it'd be encouraging to see silver. I don't want to use the word playing catch up, because that's a little bit misleading. We shouldn't always expect instruments to catch up just because a gap has opened up in their performance. We can't assume that they are ever going to catch up again. Gold may, over time, always outperform silver. So that is not something we should assume. But in any case, this is part of the evidence. And I've labeled this sort of the good area and the bad area. It's just that if gold starts to strongly outperform silver, then it's not usually a particularly good sign for the precious metals as a whole. Silver outperforming gold in a strong bullish move is more favorable. So we are just about in this good zone at the moment, and over time I'd like to see silver continue to outperform gold. So I'd like to see this chart continue to move to the downside. Now, looking at silver itself, and this is again is using the forest to tree approach. So we're looking at the big picture first. and this goes all the way back to the 1970s. I've labeled the bull market for silver, bear market, the basing period, next bull market, which broke out here and rose all the way up to the top here. So that was a bull market. And then we had a bearish phase. Now, I'm not going to say it's a bear market because it's a bearish phase that you could view as being in an ongoing bull market. We didn't come all the way back down. It's formed a base at a higher level, and we are now breaking out. So I want to zoom in a little bit here and just look at this period from, let's say, 2010 till now. The 28 level, $28 level is important. It was significant support during this period, sort of between 2011 and 2013. It kept testing that $28 level, and when it eventually broke below it, then we came all the way down to somewhere around $12 or a little bit less. And then on the way back up, the 28 level was important again on this monthly chart. These candles are monthly candles, so the price is oscillating up and down within these candles during the month. And then at the end of the month, the candle is fixed, and we move on to the next candle. Green candles if we close the month higher than we opened, and red candles if we close the month lower than we opened. And you can flick between candle charts and line charts. So if you want to make it simple and just plot the line that joins each monthly close, then you can hit the symbol for the line chart, and you can, it just kind of clarifies it, makes it simple. It gets rid of the candles, and it's a simple line chart. And on the line chart, you can see that $28 level is very important. So, okay, so we know 28 is important. Now let's zoom in a bit and look at the weekly and look at the period from 2020 to now. So we're getting down towards the out of the forest and into the trees. So 28 is that level that we want to bear in mind. Okay, so what I'm going to say at this point is, as long as we are on a monthly closing basis above 28, then the bull trend is intact. But you have to wait until the end of each month to get that confirmation. Now, on a weekly basis, the 28 level is also important. It's not quite so clear cut because we have a couple of candles here and there that slightly violate that 28 level. So you could say it's 28 to 28.64, 28.65. So there's a zone of support in there on the weekly candle chart. And we're starting to see on this weekly candle chart evidence of an expanding descending wedge. Okay, so you've got the support line, you've got the resistance line. Excuse me. So now what we want to do is take a look at it on the daily basis, so the daily candle chart. And there we have the daily candle chart, and that expanding wedge is much, much clearer on the daily candle chart. We can see very clear support in there, and we can see very clear resistance tied into those upper and lower thick black lines that I've got on the chart. You can also see these rising support lines. There's one on the previous upside move, and there's one on the current upside move. Okay, so you've got two rising trend lines. Now notice on the latest one that we've just sort of dipped down below that rising trend line, and we've broken it, and we still haven't actually hit the upper resistance line. Now the upper resistance line is going to be about $30.45, $30.50, that kind of level. So what can we conclude? Well, any move above $30.50 would be very bullish indeed, because that would be a breakout from that expanding wedge. So that's the first thing to say. So a daily close above, let's say $30.50 would send a strong bullish signal that the next up leg is coming. So so what I've said now is that any move below 28, and we probably should be just stepping aside for however long it takes, because 28 is an important support level, and there's no point hanging around in silver if it breaks down below 28. Okay, that's the first thing. The next thing is, if we break above 30.5, where's it going? So you notice I've got some lines on the chart there, a red line, a green line, and a black line. Now, if I just press a couple of buttons here on the keyboard, those are distance, well, they're moving averages. So the red line is the 12-period moving average, the 12-day moving average. The green line is the 36-day moving average, and the black line is the 150-day moving average. You can pick more or less any numbers you want. I could have put 10, 50, and 200. You know, you're going to get the same analysis out of this So the point is to pick a short, a more medium, and a longer term figure. Okay, and then what you get if you plot the distance from moving average, it's plotting how far away you are from each of these lines. So you can see the price is very close to the red line. So in terms of the distance from the 12-day moving average, we're almost at zero, because price is almost on that red line. It's almost on the 12-day moving average. It's also quite close to the green line. So you can see the green distance from moving average being plotted here. We're only 2.5% above the 36 period moving average, the green line up here. But we're quite a long way above the black line, and the black line is the 150-day moving average. And you can see that we're currently 7.5% above the 150-day moving average. Okay, well, that's all very fascinating, but how does that help us? Well, it helps us in estimating where price might be going, because if we look, for example, at the more medium term moving average here, you can see that generally speaking, apart from occasional spikes, which we can't sort of expect, they just come along unexpectedly, sort of thing. But more generally, we top out at about 12 to 14% above the moving average. You can see all these multiple occasions where we get to 12 to 14% above the moving average, and then price retreats. So where is 12 to 14% above the 36 period moving average? Well, I've of course calculated that for you. So the 36 period moving average is the green line, and if price begins to break to the upside, the green line might rise at this sort of angle. I'm just borrowing the angle from the previous leg up. So if it turns around, it could move up at that angle, which means that, let me just draw a dotted line to show you what might happen. So your 36 period moving average could do, and emphasis on the word could, do that sort of thing. Like that. Let me take that line away now. Okay, so if we were to start moving up pretty rapidly, we can guesstimate the sort of angle of ascent. It might be something like that. So it could be something like that, for example, if we were to start moving up fairly rapidly now. So in terms of time, when we get to our target, it could be sometime towards the end of September. And in terms of target, well, 14% above that moving average is going to be somewhere around $34, isn't it? 12% above the moving average would be, of course, lower, and that would be around $33.50. So let's say $33 to $34, could spike higher to 35 or higher if we get one of those spikes. Okay, so that's an estimation of where we might go using that particular moving average. Now, if we use the 150 period moving average, we can see that it usually gets up to around somewhere around 15, 16%, can go up to 30%, and in a very spiky move, it can go up to 65%. So, you know, it can go crazy percentages higher, at least 50, 65%. But if we're not greedy, and if we just say that we're going to get a move up to a regular sort of peak, it would be between 20 and 30% above the 150 moving average. So 20 to 30% above this moving average. And let me just move the starting point down to that moving average. 20 to 30%. Well, 20% would be $34, 34.5, and 30% would be up near 37. So that gives us a slightly higher target range, and gives us a little bit more confidence that we could spike a little bit higher into the mid to upper 30s, as opposed to the sort of lower to mid 30s, around the $34 level, for example. So we're starting to build a target area, a target zone based on different moving averages, and it sort of is in and around this sort of area here, kind of zone topping out perhaps in the upper 30s, and the lower target zone might be around 33, 34. So that's the sort of target area for silver, as long as we A, stay above $28, and B, get that break above $30.50. Okay, so those are the two numbers to remember. 28, we've got to stay above. 30.5 would signal a high probability of a move towards that those mid-30s. Now we can do some more classical TA on this as well. The breakout from the previous basing period was actually here at about $26. Now we can measure $26 to sort of $32. That was the flagpole. This is a flagpole. That's the flag. And if we place that on top of the breakout level, and breakout level would be $30.50, as I said, then that gives us a target value of $37 as well. So a couple of different methodologies there pointing towards the $37 level. It depends how you measure your flagpole here, but I think that is a reasonable place to measure the flagpole. I mean, we're actually being quite conservative there, because you could argue that the flagpole is that. Let me just make the line a bit bigger for you. You could argue that that's your flagpole, and that's going to go on there, and you're going to end up at $44. So by measuring this as the flagpole here, we're actually being very conservative, and with that estimation of $37. So again, it's going to be a case of watching as this progresses. I suppose as we get into the mid-30s, assuming we do, and assuming we get the breakout and we get into the mid-30s, then whether we spike into the mid-40s somewhat depends on unforeseen events and how the market is reacting at the time, and how the price chart looks at that time. I mean, the price chart would look pretty stretched, and the distance from moving average would be getting very stretched, of course. So profit taking area for silver, assuming we do hold above $28, is going to be anywhere upwards from, let's say, 34, shall we? I think 33 might be a bit too conservative. So anywhere from 34 upwards would be your sort of profit taking area, because I suspect once we do hit the peak, this next peak, then the hangover from that could be fairly severe. It wouldn't surprise me if we had a large drop back down into the low to mid 20s, which of course, if we're up somewhere up near the high 30s, would be a bit painful for many. Okay, that's the forest to tree approach for silver. That went on a little bit longer than I anticipated, but I hope you found it useful. And let's just watch those numbers, shall we? $28 on the low side and 30.5 on the high side. That's what we're looking for. Okay, that's it from me for now, and hope you all have great days. Speak to you all soon. Bye-bye for now.